Vinit Sambre is joining us from DSP to talk to us about what we should be doing with the market right now because, of course, there's a lot of news flow that we have to deal with. He's, of course, the head equities at DSP Mutual Fund. Vinit, hi, good to be speaking with you. Good morning. First up, your sense on the market because we were just discussing how it was supposed to be large cap that were expected to come back, but it's the mid cap and the small cap indices that continue to lead the rally. Do you expect this to continue a lot more momentum in the broader markets versus the large caps?
Thank you for having me on the show. So I think clearly, first of all, it is becoming incrementally very difficult to forecast and predict the short-term moves. But one thing which I wanted to sort of mention, when we generally talk about the large caps, mid caps, and small caps, and the divergence in the performance, I think previously what used to happen is that there used to be some kind of divergence in the performances, business performances of the small caps, mid caps versus the large caps, which used to clearly have some kind of implications in terms of the stock price performance. But what we've been seeing, really post-COVID, last 3 years, there is a broad basing which is happening as far as the growth is concerned. And many sectors which had not participated earlier in terms of the broad-based business growth, which is, let's say, the engineering, the railways, the real estate, these are large segments, and these have implications on the broad set of companies which falls within the middle small cap space. So what we are seeing is that the growth and the visibility and anticipation of growth, which is becoming more broad based, is slightly better versus the past, and hence we are seeing that the there's a correlation between the small caps, mid caps, and large caps, mid caps, and small caps. And in reality, these are also the segments which have been doing extraordinarily well because there's a lot of flows which is backing these category. So I think till the time the growth metrics remains intact, my sense is that small and mid cap also deserve fair share of allocation. Just today, given the valuations where we are, I think incrementally investors should align to slightly longer term thinking. Near term could be challenging. Maybe 1 year one should give up returns expectation is what I can sort of guide or warn the investors.
I look at the market and I say, okay, wow, everything is looking great. Earnings are strong, GDP is strong, the sectors you mentioned are doing very well. But the biggest, in a sense, mirror of economy is what banks do. And with banks now, there seems to be a slowdown, both in terms of credit growth and also in terms of deposit growth. So if banks are slowing down, then do you think it's a matter of time economy will also slow down?
So it is very fair point, and in fact, which is what I was sort of referring to. Next 1 year could be challenging, and I'm coming from the same thought process. That let's say the last 3 years we saw earnings growing at a CAGR of 22-23%. Let's say as far as the Nifty is concerned, and this year the estimates which are coming out, the consensus estimates are talking about it started with 15%. Now we are sort of getting down to 13-14%. So I think overall there is a sense of slowdown. A lot of the businesses are seeing moderation. The benefits which a lot of these companies got because of lower raw material price, those are also sort of going away. And a combination of all of that is, we believe that earnings could slow a bit over the next 2 or 3 quarters, and which is where the valuation premium which a lot of these companies have got, maybe it calls for some consolidation or some time correction or absolute correction. So I think the whole thought process is that as we enter the next few quarters, there could be slowdown. You're right, banks. If we look at the retail lending, that has also sort of slowed down. And in this context, my sense is that the texture of or the mix of the growth should change. Really, the urban, which was doing extremely well, should give some way to the rural, anyways, because of the government's also likely focus to sort of grow the rural side of the economy. So my sense is that the balance would change, but and the growth moderation would be there, and hence the valuations should sort of remain under check.
Vinit, while there is no denying that small and mid cap stocks have seen a huge run up, everybody is of the view that you need to be a bit careful there. But that is one space where there is outperformance and there are flows. As long as there is flow, there is performance. And as long as there is performance, there is flow. How long will this so-called, cycle continue?
Wish I knew that. But my sense is that, as I said, I think what drives the flows also is the fact that the visibility of growth. Until the time you see visibility of growth, and those factors present, my sense is that flows would sort of keep chasing, the visibility of growth. And what metrics can break the growth down is something which today it is very difficult to sort of think. As I said, maybe as you enter the slow quarters, maybe that gives some kind of that raises some kind of concerns in the minds of investors around growth, and there could be some moderation over the next 1 or 2 quarters. But I think the sense is that as we are marching ahead in terms of economic expansion over the next few years, I think you may have volatility in the interim, but the long term picture looks okay. And whenever we talk about small and mid caps, remember, we have always mentioned that the any investors walking into this category, especially at high points, they need to keep expanding their time horizons, because in the short term there could be some blips which could hurt the sentiments of the investors.
You like healthcare. Now that's the odd one out because healthcare is a very divided theme. I can look at a Pfizer which is domestic. I can look at Aurobindo Pharma which is generic. I can look at Cipla which is mixed. What do you like within healthcare?
So we have, a basket of companies which are focused on domestic and as well as the US markets as such. I think we have gradually expanded our exposure to companies where they are, catering to the international markets, because we see the trends even in the US markets are at the margin shifting. The generic pricing environment is slightly getting better, and companies have been sort of showcasing good results. In fact, when I look at the quarterly estimates which are coming out, healthcare seems to be sort of shining out. There are one-offs, I agree. There are one-off drugs which are benefiting the companies, but I'm saying that overall the environment has been decent for the healthcare sector, and the valuations are not at the top. I mean, we are not calling healthcare as a category which has reached astronomical kind of valuation. So from that point, I think it is best, I can say, defensive and play where one can hold on their exposure into the healthcare sector.
Morning. Let's also get in your perspective as to what the outlook is when it comes to hospitality and retail, given that a lot of companies within these spaces have been going gung-ho. There's favorable demand-supply dynamics, for instance, when it comes to hospitality. But do you think that perhaps the story has already played out, or there is still room to go for both of these sectors, retail and hospitality?
I think somewhere we are looking at the segment reaching towards the top end, both in terms of their business metrics and in terms of the valuation. So hence, we would sort of be slightly more careful, and we would like to look at the segment at more reasonable price points, while we have a decent and a reasonable good long-term view. But I think at the moment we have reached a topish kind of a scenario, both on the business front as well as on the valuation front. So we would like to sort of remain a bit more cautious around these segments.
I know it's not your style of investing, but if you had to take a tactical bet around budget, what would that be? Is FMCG something that comes to mind, given the valuations are a lot more comfortable, plus, of course, rural recovery is high on agenda?
Yeah, so while incrementally we are watching the FMCG sector from the exact viewpoint which you mentioned, and maybe there could be a case where during the budget these announcements could favor these companies. At the same time, our long-term thought always suggests that the consumer discretionary as such has in the long run outperformed the FMCG kind of companies, because FMCG companies in general have reached very high penetration, and the growth matrix maybe moves up from a low single digit to high single digit. But beyond that, then again, one will have to sort of relook at the valuations. So I think from a long-term view, we have been more positive around the consumer discretionary, and within discretionary, we have a lot of spaces to look at, maybe auto ancillary, QSRs, and garment companies. So I think these are the segments which we sort of have a decent exposure in.
Okay, fair enough. And do you believe that we can see scope for earnings growth within select sectors like, say, IT or even the autos, FMCG companies? Which are the sectors where you believe that that will be promising amongst the lot?
So, as far as the earnings are concerned, my sense is that, over the next 1 or 2 quarters, overall, as I said, there is a moderation which is expected. Banking sector, which has been growing at upwards of 20-25%, will sort of come off at around 14-15%, but that itself is a decent growth. I would say that purely from the earnings perspective, the engineering capital good companies, they should show strong earnings momentum given their order book have been order inflows have been good, and only thing is that the valuations there are pretty high, and one has to be slightly more careful. And as far as the IT sector is concerned, maybe they are showing signs of bottoming out from a flat to very low earnings momentum. Maybe they pick up some bit and they go in the high single digit kind of range. And over the next 2 quarters, we see that the sector should sort of come out of the low growth phenomenon is our expectation. So I think broadly, and healthcare, as I said, is likely to show decent growth metrics over the next maybe 1 year or so. So I think these are some of our estimates around these segments.
It could be a coincidence or maybe it's a pattern, but I've always seen that there are sectors which tend to do very well when you catch the theme. For example, if you bought into defense stocks 10 years ago, you did not make money. But if you bought into defense stocks post-COVID or railway stocks post-COVID, that's where the incremental, delta has come in. So considering that this government will have a different way in which how they would be spending and how they would be governing, is there a theme which could be a standout theme which you would like to bet on? It looks like a small theme right now, but it has potential to become big.
So I think, frankly, Nikunj, when we scan across different categories, segments, across market capitalization, I think because of the kind of flows which we have seen in the markets over the last 3 years, uh, most of the themes seems to be either reasonably valued or richly valued. It is not that any specific themes one is sort of seeing reasonable level of valuations. That is number one. Now, the other aspect from the returns perspective is where in the business cycle are these themes? So maybe the valuations could be reasonable, but the business cycles could be at the lows, and hence it is still okay to maybe catch some of these at the juncture today. So from that perspective, when I look at the business cycles, I believe the specialty chemicals is at a low cycle, and some data points are suggesting that there could be signs of recovery when we look at the global agrochemical companies and their commentaries out there. Similarly, the IT sector, as I mentioned, is at the business lows, and as the scale up in the growth metrics happens, maybe there we could see some bit of expansion going forward. So likewise, I think the segments which are connected in some form or fashion to the agri market. So agrochemicals has been lackluster for the last 2-3 years. Maybe we could sort of see some bounce back. We've already seen some catch up, but I think there's some more room which is left out there. And the segments which are more focused on, let's say, agri, the two-wheelers, entry level, all of those, I think would be the ones where relatively one can look for some outperformance heading into the next 1 year or so.
Just to wrap it up with one point on IT, when will IT start turning? Because there is early evidence that's what companies are telling us, that the AI business now is increasing for them. Are we at the turn for IT?
So AI is still debatable, and the verdict is still not out. But my sense is that, as we saw in case of, I mean, that's my assumption, and that is what I'm working with, is that what we saw in case of the digital and the cloud-based businesses, which our IT companies did catch well. My sense is that even in case of AI, because the scope of work is going to be huge, each and every company would want to sort of have some kind of AI tools. I think the outlook should be positive as far as IT sector is concerned, and these companies, like they have done in the past, the new technology capture should be better. Is what I am believing.
Vinit, thank you for taking time out and joining in. Good to get in your thoughts on the markets as well as promising sectors.
If you like this video, then like, share and subscribe to ET Now.